Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering the woke ESG scam collapse. Investors want their money back. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. Coming from the Financial Times, don't judge ESG through the investment lens. Coming from Yahoo Finance, ESG investors shaken by sell-off, told to brace for more pain. From Bloomberg, ESG veteran says stay away from ETFs as purge drags on. He's talking about ESG exchange-traded funds. Another failure in ESG. From Quartz, a new study finds returns on ESG ETFs to be unremarkable. Sustainable investing is still about the long game. Sure, just give them your money and wait forever to get a return on your investment, while if you do the research and you do the homework, you see that ESG is completely collapsing. From IPE.com, ex-BlackRock research head, ESG's biggest sin is conflating finance, impact, and ethics. From thenewrepublic.com, the real cause of ESG's big crash. Republican governments across America have passed anti-ESG bills, but that's not why the investment principle has fallen out of favor. And from Just the News, House Republicans blast ideological woke investing for threatening America's retirement savings. That sounds kind of important. If you're going to threaten Americans' retirement savings, how are they going to live when they retire? From the Financial Times, don't judge ESG through the investment lens. Well, if you're going to be investing in ESG-related things, you would want to judge them as an investment. But let's see what they have to say. Aswaf Damadoran demonstrates that all attempts to fit environmental, social, and governance thinking into finance theory fail. But this should not be a reason to bury it completely. ESG is doomed to fail under the laws of capitalism. So they go on to then explain, like, look, it's going to fail under the laws of capitalism, but that's not a reason to not invest in it. Like, no, actually, that is the reason to not invest in it. Anytime you make any kind of investment, your number one concern should be what the return on investment is going to be, and that should be a financial return. If you have spiritual things you're looking to put out into the world, or you're trying to help a community or whatever, there's all kinds of charity that you can do. But when you make investments, financial investments, you're expecting a financial return. Otherwise, there's no accountability whatsoever, and God only knows what they're going to do with your money, but it's not going to give you any kind of financial benefit. The theory here is that because ESG doesn't comply with the latter's most fundamental driver, growth, you can't expect to get a good financial return. Greenhouse gas emissions should be reduced to preserve life and nature, wages increase for an equal society, and corporate structures further staffed to ensure accountability. None of these measurements are meant to grow capital, yet they're wise and essential. And by grow capital, they mean provide any kind of return on your financial investment. ESG should not be looked at through this investment lens. Its value should first be considered without any financial motive. Well, yeah, but not for financial investments. You can make political donations. You can make political endorsements. You can select your religion based on your religion's beliefs on helping other people. But when it comes to financial investments, it's not a religion. It's not supposed to be political. We're not trying to get these corporations to take our money and then come up with a new way to structure society. We're trying to give them money to get more money back in return. Capitalism has taken its toll on people and societies, and ESG is an opportunity to reset it by becoming one of the so-called pillars of Capitalism 2.0, providing a framework to give a wider and long-term sense to corporations' existence. It would be unfortunate to throw away any sensible concept under the pretext that it doesn't provide shareholder value. Yes, no, if you're going to make a financial investment, you should be getting a financial return on that investment. Really, that's it. If you want to make a donation, you can do that. If you want to just help people out as a favor, you can do that. But when you have financial money managers like Larry Fink handling trillions of dollars of other people's retirement money that they worked and saved for their whole lives, yes, you should expect Larry Fink is trying to get you a strong financial return on your investment, not some social or political goal. However, from Yahoo Finance, ESG investors shaken by sell-off are now told to brace for more pain. Why should you be bracing for more pain? Well, if you were fooled into investing in this ESG scam, where they said, listen, if you just force corporations to follow this political idea that we have and follow this social justice idea that we have, that's going to be great financially. If they fooled you into doing that, of course you're going to lose money doing that. The bad year that a lot of ESG investors are having may be about to get even worse. According to James Penny, the chief investment officer of TAM Asset Management and a veteran of ESG investing, the dramatic sell-off that's torn through green stocks may soon morph into a slow burn that could last several more years. Several more years! They do this without shame. It's incredible. People should be going to jail. The green correction, with the S&P Global Clean Energy Index down more than 30% over the past year, so around the same kind of reduce in stock price as Target, for example, has definitely shaken some investors within ESG impact sustainability, Penny said in an interview. It's definitely been a tough time to be invested in thematics in sustainability. This was supposed to be the year that investors targeting environmental and social goals would see their assets buoyed or increased by historic support packages such as the U.S. Inflation Reduction Act, which was a multi-trillion-dollar plan by establishment Democrats and establishment Republicans to subsidize all types of ESG investments. Instead, decades-high inflation and soaring interest rates ended up hammering a lot of traditional ESG stocks, with wind and solar standing out as some of the biggest losers. For investors, the main risk now lies in sticking with the kinds of passive green strategies that exchange-traded funds offer, Penny said. This situation, to avoid a slow burn, is getting stuck with companies that consistently are under pressure. There will be companies that just can't survive, and there will also be some that will outperform. So you don't want to own thematic ETFs that own the whole market in that space, Penny said. Active management is key. What he's saying is you don't want to be stuck owning a bunch of solar companies because it's through an exchange-traded fund where they invest by category rather than specific company. So he's saying all you need to do here is pick the one or two companies that are going to actually succeed and be able to stay in business, which is also incredibly difficult to do. ESG is a ridiculous investment strategy. ESG investing has struggled to regain its footing since the pandemic, when lockdowns drove energy prices and buoyed portfolios that shunned fossil fuels. But when those lockdowns ended and economic activity came roaring back, so when people actually started leaving their houses and kind of going to work and driving around again, the world order that followed proved poisonous for many ESG strategies. Because the strategies for ESG never anticipated people ever leaving their houses again? Doesn't sound like a good strategy. A lot of ESG companies are capital intensive, which makes them more vulnerable to higher borrowing costs than oil and gas companies with well-established rigs and platforms. To make matters worse, wind and solar producers have been hit by project delays exacerbated by supply chain bottlenecks. The best performing ESG funds are packed full of tech stocks like Microsoft and Nvidia, while some of this year's worst performing ESG strategies are overweight renewable energy stocks such as Siemens Energy AG and Ørsted AS. Both companies have lost roughly half their market value in the last year. A few years back, ESG was attracting investors who were there not just because they wanted to do good, but because they thought the strategy would deliver big returns. A lot of those investors have since walked away, which may not be a bad thing. For ESG fund managers, quote, it's probably quite a good thing that they've washed out all of the hot money and it's just left with their dedicated capital, according to Penny. This is just a complete disaster and people should definitely go to jail. Quote, there are going to be some companies out there that are struggling, but that also have, quote, great intellectual property, great ideas, and great disruptive trends, he said. You're going to see a lot of mergers and acquisitions in that sector because a lot of companies will merge together either because they don't make sense at a smaller size or because they can't afford to exist anymore as an independent company. Ex-BlackRock research head, ESG's biggest sin is conflating finance, impact, and ethics. This is this guy's company, Larry Fink. The former head of fundamental research at BlackRock Sustainable Investing is calling for a rethink of green finance, describing the current theory of change as an illusion. Carol Crozat, who resigned in 2022 after 3 years in that role, told IPE, quote, that the most important thing sustainable finance needs to work on is clarifying the objectives of the people who choose to invest that way. Because you should have some kind of an objective if you're going to make an investment. If you want to do it for a social good, that's okay. If you want to do it for a financial return, that's what most people do when you make financial investments. She said there needed to be a much clearer distinction between risk-adjusted financial performance, ethics, and the pursuit of impact. Quote, the biggest sin of sustainable finance over the past 10 years, especially when it started going mainstream, is maintaining the illusion that those three objectives could always go together, said Crozat. Crozat said that after the 2015 Paris Climate Accord, sustainable investors really believed that those three objectives were aligning. Quote, all of these companies and countries were committed to the same goal. So we thought that we'd get everything we needed to get to net zero, carbon prices, regulation, technology, etc. That made it sensible to invest in companies that were better placed for the transition. But cracks started to show when there was a lack of progress towards the goals of the Paris Climate Accords, made worse by the European energy crisis after the war in Ukraine. Collectively, investors understand that it was an illusion, that over the short term, governments will always prioritize jobs and the economy over any long-term target, she noted. And that's when this belief that these three objectives sit nicely alongside each other completely unravels. The thing that I see about this is it's incredible that all of these sophisticated people, very intelligent people, understand business, understand the world, have access to unlimited resources in research, in professional networks, don't seem to understand that just because they make up some idea of how to remake society, you can't do that through investing. That's a governmental policy kind of thing, and it also goes to what people's values are. You can't just push your values on the entire population of the world. It's impractical, it's unethical, and it goes against their actual fiduciary responsibilities. The reason they're managing other people's money is because they've made a promise to give people the best financial return on investment that they can reasonably expect. They're supposed to be doing that as financial experts. But when they all of a sudden say, no, we have to do something much more important, we're going to save the world and remake society with your money, that's when, of course, it goes completely off the rails. Coming from Just the News, House Republicans blast ideological woke investing for threatening Americans' retirement savings. According to Jason Isaac, director of Life Powered, not a single of the largest individual ESG labeled funds performed better than the S&P 500 or the NASDAQ. Returns on the top 20 largest ESG labeled funds, he said, were negative 0.2% during the past year, while the S&P 500 was up 19% and the NASDAQ was up 25%. Yet Democrats continue to push for ESG's prominence in the mix of investment strategy. House Republicans again took aim at the use of environmental, social, and governance policy in retirement investing during a Ways and Means Committee hearing titled Ensuring Woke Doesn't Leave Americans Broke. This political crusade threatens the $33 trillion Americans have saved for retirement. As a committee, we have a responsibility to ensure that tax-advantaged retirement plans offer security to American seniors and future retirees, said Representative Jason Smith, chair of the committee. Referred to as woke investing by its critics, ESG generally includes a set of standards that rates funds according to their progressive-friendly, socially conscious measures. These range from the racial and gender diversity within a company's governing board to its commitment to lowering carbon dioxide emissions. They do not speak to the fiduciary duty that companies owe their investors. Critics say that ESG directs financial decisions toward political agendas that are often at odds with getting the best returns for investors while having the effect of policy without any legislative process. The concern with using ESG in retirement investing is that Americans are putting their faith in investors managing their retirement funds, but rather than ensuring the best outcomes for those investments, the money is being directed towards advancing political causes at the expense of those investors, which, if you think about it, really is just straight up evil. From a good and evil standpoint, that's a straight up evil thing to do. From the perspective of someone who wants a return on investment, or at least wants to see other people who have worked diligently and have saved their money get a good return on their investment so they can provide for themselves in retirement and maybe leave something as an inheritance to the rest of their surviving family, you can see the good versus the evil. But these are competing social value systems. The value system of your investment manager should not affect your investment manager focusing on getting you a return on investment. But it really does. If they think that all that matters is cultural Marxism and the woke agenda, they don't care what happens to you and your future family's inheritance. In November 2022, the Department of Labor issued a final rule that allowed individuals and companies managing retirement investments to consider ESG factors in their decision, including climate change concerns. In March, Congress passed a bill that would have shot down the Department of Labor's rule, but President Joe Biden, as he has promised to do, vetoed the legislation. In January, 24 Republican states attorneys general, along with 2 energy companies, filed a lawsuit against the Department of Labor aimed at getting the ESG rule set aside, but a Texas federal court dismissed the complaint in September. At last Thursday's Ways and Means Committee hearing, Representative Smith noted that inflation had driven the cost of goods and services up 17.7% since Biden took office, and as a result, 1 in 6 seniors are considering going back to work. Many Americans, Smith said, are expecting to delay their retirements as inflation erodes away the buying power of retirement accounts. Quote, make no mistake, the Democrats' reckless spending agenda caused this problem. And now their radical ESG agenda threatens what's left of seniors' retirement, Smith said. Jason Isaac, director of Life Powered, an initiative sponsored by conservative think tank Texas Public Policy Foundation that seeks to educate people on the importance of affordable and reliable energy to human well-being, said that not one of the largest individual ESG-labeled funds performed better than the S&P 500 or the NASDAQ. Returns on the top 20 largest ESG-labeled funds, he said, were negative 0.2% during the past year. So if you think about it, what was the point of investing in ESG in the first place? Quote, Congress must and should do everything in its power to stop this overreach and what is supposed to be a free market with fiduciary duty. For Republican members of the committee and most of the witnesses, ESG represents a real threat to retirement investments and the state of the free market. Life Powered's Isaac recounted the experience of Sri Lanka. In 2022, the South Asian country's president implemented a rapid transformation of its agricultural sector following progressive environmental policies that sought to eliminate modern fertilizers, genetically modified crops, and greatly lower carbon dioxide emissions. The nation's economy imploded, leading to riots from which the Sri Lankan president fled. Quote, today 9 in 10 people are hungry in Sri Lanka because of one person, the president who put in their ridiculous ESG agenda. While the debate continues on the federal level, states are also taking action for and against ESG. As of September, there were 20 states with laws that limit considerations of or the weight given to ESG factors in investment decisions. 8 states have laws either protecting or incentivizing ESG-related investments, and 3 states have laws requiring companies disclose their use of ESG factors in the course of their business. Another factor that might sway the debate one way or another, at least as far as the climate standards of ESG are concerned, is the financial outcomes of renewable energy companies compared to oil and gas companies. Both the Daily Caller News Foundation and Reuters reported last month investors are pulling out of renewable funds as margins decline, suggesting that regardless of any legislation that's passed, the influence of ESG may fade in the face of financial losses. ESG is a scam that people should be held accountable for. In the meantime, investors are getting out of ESG. I can't give investment advice, but I will say this. A lot of people are getting away from anything to do with ESG. If you have a pension plan, if it's administered through your employer or if it's administered through your accountant, whoever handles it, it's a good idea to at least find out if you are or you're not invested with ESG investments. You can tell them, listen, I don't want to have anything to do with ESG if that's how you feel. Of course, don't just take one source of information for making your financial decisions. Google it, look it up. But ESG is looking like a financial disaster for individual investors. If you can get away from it, I absolutely would get away from it. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.